You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody, welcome back to Options Bootcamp, the program here on the old Options Insider Radio Network, where we dive deep into those educational options waters. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fun network upon which you're listening to this fine program right now, or maybe you're listening to it. A lot of you like to listen to just directly from the Bootcamp feed. If you're just doing that, A, we like you, we welcome you. B, you're missing out on a whole bunch of other great stuff on the network, roughly a dozen or so programs for you guys to sink your teeth into. You like volatility, we got that. If you like futures options, we got that. If you like advisors and options, we got that. If you like more stuff for active retail out there, basic retail, we got all of that in spades and a lot more. So wherever you listen to this, make sure you upgrade to subscribe to the full network. We'll have stuff hitting you pretty much every day, sometimes a couple times a day out there. So we will keep you informed, engaged, enlightened, indeed entertained, hopefully, out there. And if you have a question, a comment, hit us up. We do love to hear from you guys. And we also like to hear from our compatriots here on the old program. First off, joining me once again, the black-hatted one himself, Mr. P, a.k.a. Dan Passarelli, the founder of Market Taker Mentoring. Mr. P, welcome back to Options Bootcamp, sir. It has been far too long.
Oh, such a long time. Oh, my God. I can't even tell you. Good to be back.
Good to be back. I know. Hopefully you remember how all of this works. And also joining us once again, holding down the NASDAQ hot seat, Mr. Eric METZ, the Chief Investment Officer over there at SPIDERROCK Advisors. Eric, welcome back to you. It has been too long as well, sir.
It has been. I appreciate it, Mark. Looking forward to it.
All right, let's get to it then. Answering some of your questions. It's time to break out the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, the portion of the show where you guys take the reins, your questions, your comments, your insights. We'll try to get to as many of you as we can here on today's episode. So let's just dive right in. Let's start off with this question coming in from YouTube. More and more of you liking the YouTube as a way to consume the show. If you do, have at it. We don't judge. However you like to listen to the program and get at it, we put it out there in kind of an automated fashion on YouTube. A few of you have requested some playlists. We have done that now for different shows, including Options Bootcamp. If you want to just go to the YouTube and listen to Bootcamp, you can do just that now, just like SD Investing did. SD Investing says, hello, I'm following your videos since a few weeks, especially volatility views. Oh, well, he likes the vol show. Well, there you go. Glad to see you liking it. What do you mean when you talk about a put 1x2? Is this a strategy on VIX or SPX? or can it be used in either ways? A great podcast with useful infos. Cheers from Italy. Ciao. Obviously, English, not your first language, but you know what? You're doing pretty good at it there, SD Investing. He also follows up, since he's nice, we're fans of the Italians here, me and obviously Mr. Passarelli. I can't speak for Eric, but he probably is too. So we'll cheat. We'll allow you to ask two things here. Usually we limit you to one, SD. But he followed up with another one, says he likes covered calls. He wants to know, how do you manage the short call if it's below the strike that you let expire? So I think he means if the stock is below the strike you sold in the covered call, what do you do there? And what do you do if it's above the strike? So kind of a combo question. Eric, you're our guest, so I'll give you pride of place on this one. First off, he wants to know, what is a put 1x2? So obviously he means a ratio put spread, either selling one or buying two, or, buying one, selling two. So maybe let's start with that. And then B, if you want to dive into covered call management, it's a lot to unpack there in a very short show. But he wants to know, how do you manage your covered call? Maybe when the stock's below the strike, not that interesting, but when the stock goes above the strike, do you close it out? Do you roll it? What are your thoughts on those two questions? So ratio, put spreads, and how do you manage a covered call, Eric?
Sure, I'll take it away. Ratio to put spread. So first point of the question, can you do this on VIX or S&P or anything? Any instrument that has listed options is viable to engage in a 1x2 strategy. I'd say there's two rational reasons why one would want to, I would say, buy one and sell two. If you are a long stockholder, so we'll use Microsoft, and if you wanted to buy a put that was closer to the money and protect yourself from downside, doing that, but defraying the cost of that by selling contracts beneath there. And then furthermore, knowing that you are a fundamental long holder of the stock, give yourself the ability to actually buy more stock even further below there, right? That is the mindset of, why somebody would want to engage in that strategy from a retail perspective. So just kind of quick summary there, protect yourself for, call it 5 to 15% down. And then, want to own more Microsoft at, down, call it 25%. That strategy is very prudent to take advantage of that mindset. I'll quickly shift gears in the interest of time over to the covered call conversation, which is, how do I manage covered calls if the stock is above or below strike? The number one mystery here in covered call management is that when the stock goes above your strike price, you are not at risk of early exercise. It is very methodical. We addressed this in the last conversation, Mark, on your show. But don't panic if you're through strike. You have time on your side. That's why you engage in the program or the strategy to begin with. And so identifying how to manage that is got a lot of moving parts to it. But I would say the following. If it's inside of 2 weeks expiration, you're probably going to want to do something in the very near future. So it's anybody's guess as to where the stock goes in the next 2 weeks. So you may want to buy it back and roll it to a new strike. But if you have a lot of time, call it more than 30 days, it's really a function of how bullish or bearish you are on the security or the market. So I would say stay the course and, be somewhat hands off unless you're trying to capitalize on, what we'll call a volatility trade and not so much the direction of the stock or to try to produce income. So that's on if the stock is above the strike. If it's below the strike, you're effectively just, long call and you're participating in that, long stock, and you're participating in that appreciation up into the strike price. So again, patience is the virtue here. If you're nearing expiration, you can probably just let it expire and re-engage in selling a new call after expiration. If you wanted to purchase it back preemptively and do the same thing, there's nothing wrong with doing that. But again, you're fast forwarding the clock into expiration, seeing what your risk exposure looks like, and if you're comfortable with that, you can transact accordingly. But wouldn't really panic if the stock goes through strike, especially if you have a lot of time left in the call option.
Yeah, people always have this weird fixation, particularly in the retail space, that if a stock goes through your strike, oh my God, that's terrible. No, you win. That's one of the best case scenarios. Unless it extremely blows through it and something has completely changed with your outlook for the stock, then you may want to roll it or take it off. But other than that, yeah, that's usually a good scenario. So great questions there, SD Invest. We love having the international folks write in. We had Germany not too long ago on the show. Now Italy, moving all across Europe. We love the international listeners. Keep those questions coming in. We just did a ratio put spread episode not too long ago here, SD, so hopefully you checked that one out. We kind of explained some of the benefits. Interesting time maybe to be considering ratio put spreads in this type of a market, particularly if you're a little bit skittish about just blasting away a premium naked out there. It might be an interesting way to do it with a little bit more of a cushion out there. All right, we got to keep on rolling. Let's see what else we got here. Mizak wants to know, hello. Well, hello, Mizak. I'm very new to options, but I'm learning and very much enjoying this program. Well, I'm glad to hear it. You are the reason this program exists, Mizak, you and the rest of people on your level out there. He says, I'm looking at purchasing call options on SPY. I understand things like cost and time to expiration, etc. What I'm not clear on is if there are any scenarios where I can lose more than the cost of the calls. Thank you. Well, Dan, this is an interesting one here. We always talk about premium buying strategies. One of the attractive things about them is usually the risk is mitigated to the cost, to the price of the option. But Mr. Mitzok wants to know if there's anything he should be aware of when he's out there loading up on his SPY calls that he could lose more than he's paying, sir.
Yeah, I like to try and be as totally accurate as I can, and qualify everything. Like the standard textbook answer to this question is, no, you can only lose what you pay when you buy a call, but that's not really the right answer. It depends on how you manage it, because if you were to buy a call on spiders, say the 304 call or something, and as time progresses, spiders rally a great deal, and if you do nothing and you would get, and it's in the money at expiration, you would get automatically exercised and you would own shares of the spiders. And if the next day happens to be the day that the spiders crash, you can lose a whole lot on that newly acquired long ETF position. So, I'm really glad you asked this question. It's really great to flesh it out and look at different scenarios where something could go more wrong that the textbooks don't describe.
Yeah, you're right. Pretty much the textbook answer is no, but there's always those weird aberrant scenarios. Eric, any weird aberrant scenarios occur to you where Mr. or Mrs. Mizak could lose more than they're paying on their SPY calls, sir?
Well, Dan hit it right squarely on the nose. I would say, in addition to the management, it's just what your time frame is, right? So if you were to buy a 1 month 304 strike call in SPY, and then 1 month passes and you do it again, and you do it again, that can compound against you, and vice versa could compound for you. So, everybody asks, do I, buy the 1 month 12 times a year, or do I buy the 12 month and just kind of hang on? And it's a complete function, again, of how you want to manage it, what your objectives are. So, yes, the textbook answer is you are only at risk for the premium that you outlay, but the frequency that you do that is the true risk.
All right, let's keep on rolling. Dan, this next one's right up your alley. We had a guest on this week on our interview program who does some things in the options educational realm, and his mantra out there, one of them out there, is that the Greeks, for a lot of the sophisticated end users out there he maintains, are kind of meaningless. In fact, in his educational system, he only devotes about 22 minutes total to the Greeks overall. And so he kind of thinks the Greeks are worthless for a lot of the traders out there. I knew that was an interesting comment. The second he said that, Dan, my thoughts instantly went to you, because you, of course, have written the book, or one of the books out there on the Greeks. And Tyler was obviously listening to that episode as well. He had an interesting question. He wants to know, do any real options traders exist who honestly believe the Greeks to be worthless? Mr. Passarelli, I'm assuming you have some viewpoints on this topic, sir, as the author of said tome. What do you have to say here for Tyler, sir?
Yeah, I'm glad that you told that story, that you had someone on your show who said something similar to that, because I was just about to malign him. So I'll be polite and I won't do that. But no, I mean, the Greeks are extremely important. I mean, the analogy that you guys have heard me make a whole bunch of times on this show they're like the instruments on the dashboard of your car. I mean, do you have to look at them? No, but you probably should. Like, you want to know how fast you're going, you want to know how much gas is in your car. I don't know what many of the other things do, but yeah, I mean, they're important. They tell you what your risk is, what your potential reward is. They give you indications that can guide your expectations. They're extremely important.
Yeah, that was an interesting, I knew it would be a contentious comment once he said it there. So, Tyler, interesting pick up there. I think, to be fair to the guest, what his point was that looking, and Eric, I'd be curious to get your thoughts on this as well, because you're dealing with a lot of large institutional players out there and clients in the advisor and option space. And a lot of people argue when those big clients come in, they want to dump 10,000 covered calls, let's say, in Amazon or whatever it is. They look at the net premium they're going to collect. They look at the time to expiration. They think, okay, I think if the stock runs to here, I get this. If it drops here, I have this amount of premium in my back pocket. Or flip side, if they're buying options, they look at it and say, okay, this option is trading for $2, and maybe I think it could be worth 10 by this time frame, so I'm buying it. They don't necessarily spend a lot of time looking at the delta or the implied vol or anything along those lines. I think that was the point he was trying to make, even though when you say the Greeks are worthless, that kind of loses a lot of that context to it. What are your thoughts on that notion that maybe the institutions view things like the Greeks a little bit different than the retail, Sir Eric?
No, it's definitely true. They are not worthless. They are everything in deriving value from the asset class, that being volatility. I would say this, the question that came in, there is some merit in assessing that they're worthless and, looking out in kind of a 30, 60, 90-day window and just assessing the total return. It's clear as day. They collect $1,000 in premium. The stock goes up and or down, and they know where they stand, and that's the premium that they garner. What they're not incorporating is what I'll call the risk-adjusted return. So total return is visible. Risk-adjusted is not. And so it's the same metaphor to say if you're a fixed income investor that you don't care where interest rates are. Well, that nobody would admit to that. And so how you derive value in fixed income instruments is by looking at your duration and your, and where interest rates are today versus where they might be in the future. It's the same exact thing from where we sit. It's just a little bit more mysterious because people, aren't as accustomed to the risk factors. And we won't go into them, but the speed at which you make money in options is a complete function of those Greek profiles. Whereas I would say at face value, you're only looking at the stock direction and maturity or the terminal value, which, that's a bookend. And how you get from today through 2 months from now is the roller coaster ride that people will be on. And those Greeks are going to determine what that roller coaster ride feels like.
Yeah, I think we all can get behind here. Knowledge of the Greeks can only serve you here. Maybe fixation on them sometimes could be a negative thing. So I can maybe see where maybe it's coming from that perspective. If you're just focusing minutely on just delta to the detriment of the rest of your position, maybe. But in general, strong understanding of the Greeks can only serve you well out here. All right. Interesting one here. Big story. Timely one. Good handle, too, because they're talking about a big story. Big Story says, love the weekly boot camp. Well, thank you. We love you, too, Mr. or Mrs. Big Story. Thank you so much. No, thank you. You're my dose of sanity during my stay-at-home times. Well, thank you. We try. I can't speak for Dan here. He's a little crazy, but the rest of us try to keep things level-headed here. He says, I'd love to know what you guys think about Credit Suisse shutting down all of its popular volatility ETNs, including TVIX. Any issues that you foresee from this? Thanks so much for answering this question. If you missed it, we talked about this on Option Block on Monday. I got a sneaking feeling it's going to be a big topic on volatility views on Friday as well. A really quick overview. Credit Suisse produces a lot of, not just, he mentions volatility ETNs. They produce a lot of levered ETNs out there with their partnership with Velocity Shares. I should say they did. They're going to delist these effectively going up to July 12th. Out there, and that includes levered 3x long gold ETNs, 3x long silver, long nat gas. You can see the full list at Credit Suisse's website out there. But the one he's pointing out, which I think is most salient to a lot of our audience, is the daily 2x VIX short-term ETN, also known as TVIX. We've had a lot to say about that over the years on our network. Most of it not that glowing. Maybe that's one of the reasons why they're shutting this thing down. Eric, this is a pretty large development in the volatility space. And when XIV and others went the way of the dodo back in February of 2018, TVIX, as bad as it is, it was really one of the last of the Mohegans out there in the vol space. What are your thoughts on this shuttering of a very popular, if not that great, volatility ETN, sir?
Yeah, I think product manufacturers, have an incentive to put, we'll call engineered product into the marketplace. and this being no different. I think in the correct hands with the correct user base, all of these have a time and a place. But using these as investing vehicles, as you know, a foray into gaining access to volatility, that's where these things go poorly, right? You got to read the entire prospectus to know, A, the math of how they're constructed, but B, what the legal rights of the ETN issuer are and what the exchanges can and cannot do. And so there's too much expertise and sophistication that probably goes into these to make them worth their while, and hence them being shut down. So do I think they're bad? No. Do I think they were misguided in kind of listing them in the first place? No. You just never know what the consumer behavior or the investor behavior is. And I don't think they were meant to be investing vehicles to express views on volatility, when I think once they got in the marketplace, that's what they became. And, that's why they may have gotten a bad rap.
Yeah, I call them Franken products often because they are engineered to replicate something else, often do sometimes middling jobs of it at best, and oftentimes people get into them without really understanding the risks. Go back and look at XIV in February of 2018 if you want a really good example. Dan, any thoughts on the demise of TVIX and some of these other ETNs over there? Were these popular with your mentees, sir?
No, not really. I mean, I've always guided my retail traders to avoid any of these highly levered ETNs. I just think you can do it better with options. Was it Warren Buffett at some point said options were weapons of mass or financial weapons of mass destruction? Was it? He said something like that, even though he uses them himself. With options, you can control your risk. These potentially actually are. I mean, to Eric's point, like they serve a purpose. They potentially have a purpose within the market, but they're not made for everybody, So, and to that point about reading the prospectus too, like there's other risks that are not obvious, like default risk, that people just don't really think about, and you really need to, they're so much more complicated than they look on the outside. You really need to deeply understand them. And, to me, I'd just rather trade options on them.
Yeah, another reason we never really liked TVIX. It wasn't optionable because for this exact reason, listeners, it's a note and get called away at any moment, and options holders tend to view such things very dimly. Look at SVXY and UVXY a couple years ago when they got neutered out there, and people take a dim view of when the underlying rules and mechanics change during an option's life, and certainly when it gets called away here. All right, we got time for a few more here. Let's go really quickly. Jack L wants to know, is there anything wrong with just buying calls on a stock that you think is going to go up? Am I just a Luddite because I'm not trading iron condors or something? Dan, this is kind of a universal misperception in the world of options. I think it has to be complex. It has to be crazy sophisticated. Otherwise, you're not doing it right. And the moral of the story, over the last few months, look at what we've seen in the broad market. We've seen an aggressive V-shaped rally out there. So even though vol has come in, that massive underlying swing means it doesn't matter if you're buying them in SPY or in the NASDAQ or maybe in some Apple or some underlying stock that you like. Straight up buying calls did work. And it is a strategy that can work. So I think just debunking the notion that it has to be crazy, sophisticated all the time is one good use case for the show here. Dan, what do you have to say for Jack L. wants to know, what's wrong with just buying a call, Dan?
Yeah, dude, keep it simple. Keep it as simple as possible, That being said, there are still certain things you need to know, not just if I think the stock's going up, I should buy calls. I mean, you want to look at volatility and you want to look at the right amount of time that you're buying on that call. And, you want to consider other spreads too. I mean, depending on what your expectations are, what your forecast is, there might be a strategy that serves you better, that helps you risk less and maybe even make more or increase your odds of success. But that being said, yeah, man, over the last couple of months, there have been times where I've just bought calls or just bought puts because at that moment they were the best strategy to trade the scenario.
Yeah, when the market's crashing, buying a put works. When the market's rallying, buying a call tends to work out there. Eric, any thoughts for Jack L here? Wants to know what's wrong with just buying a call every once in a while there, Eric?
There is nothing wrong with it. In fact, regardless of where the market is, whether you think it's at a trough or where you think it is high, there is a time and place, around the retail portfolio simply because of taxes, right? So, a lot of strategies that involve buying calls are let's take, if you bought stock in January, fast forward into the end of March, you're sitting on an unrealized loss. Swapping that risk by selling your stock, taking the realized loss into a long call for tax purposes, but maintaining the exposure for some duration of time is very prudent. In fact, regardless of the volatility level. Simultaneously, if stocks are near highs and you don't have a tax capital gains problem, selling that stock and replacing your risk with calls is very prudent, because if you do sell off, then you're only, out the premium of the call. So the time and place for these is there. Doing it in perpetuity, there's very few strategies that you can run in perpetuity and be profitable in. But, like I said, assess the situation and what your objectives are and go for it.
All right, listeners, that music means you're coming up against it. Let's leave it on a fun note here. This last one comes in from Kay Gordon. Kay Gordon says, you guys should put this show on Patreon. I'd know I'd pay for it. I'm sure a lot of others would as well. Great show. Well, thanks for that sentiment out there, Mr. or Mrs. Kay Gordon out there. A lot of people have suggested we do something like that. We like to make sure we make this stuff open and available to everyone. It's kind of been our mantra from the beginning out there. That's why we have great friends and partners like the folks at NASDAQ out there to support a show like this and make it available for you guys out there. But that said, we have been mulling over some ideas for what would make sense in some sort of premium type offering. It wouldn't be a Patreon. We're not going to go that way. It's going to be direct from us. No middlemen out there. And it would be something you're going to get above and beyond what you're getting on the network right now. So we do have some ideas on that. Nothing concrete yet. But those of you who suggested out there, clearly there's a demand for this type of thing. Don't worry, you're getting boot camp, at least for the foreseeable future. But we have some ideas for interesting things that might be fun for you down the road, and keep an eye out for those. We'll let you know if and when they come around. And the end of the show, unfortunately, has a come around. Let's go back around the horn ourselves. Let's start with our guest, Mr. Eric Metz. Mr. Eric, if folks are intrigued, they want to reach out to you maybe with a question, or maybe they want to learn more about SPIDERROCK Advisors, where should they go? What should they do?
Sure. Thanks, Mark. www.spiderrockadvisors.com is the website. Gives you an overview of the firm and kind of the strategies and services that we offer and where we're integrated at. So again, appreciate the time.
SPIDERROCKadvisors.com is the place to go to learn more. Kick the tires. You have questions about the volatility regime we're in right now, that sort of thing. Hit them up. I'm sure they'll be happy to talk to you. And Mr. Dan, I know he's happy to talk to you. Dan, if listeners have questions like a bunch of the ones we just answered, or they have a bunch more, where should they go? What should they do?
Yeah, head on over to our website, markettaker.com, and just click on the Contact Us link, and we're totally glad to help.
There you go, markettaker.com. Click on the Contact Us link, and you'll be taken over to Mr. P and the squad there, and they'll answer your options question. Check them out on the YouTubes as well. A lot of you liking our YouTube as well. So check out Dan's over there as well. And on behalf of Mr. P and Mr. Metz and indeed myself, I want to thank all of you. And of course, our friends over there in NASDAQ land. I want to thank all of you for downloading, streaming, subscribing, sending in such great questions, listening live, all the fun stuff that you do. Keep it coming. And we'll see you back here next week for more Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ. Tech forward. Leading the U.S. options market and continually rewriting tomorrow. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixler.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.